Between 2000 and 2008, Harry Markopolos filed 5 warnings with the SEC that Bernard Madoff's returns were mathematically impossible. Not one led to action. Madoff is one of 10 cases we're counting down, from forged bank balances to fabricated assets where the institutions meant to stop fraud had the evidence and failed. The mechanisms change. The blind spots persist. We begin at number 10 in 1919. In the 10th place, Charles Ponzi's scheme set the template for financial fraud in the modern era. Between August 1919 and August 1920, Ponzi promised investors a 50% profit in 45 days, claiming he could exploit price differences in international reply coupons, small postal vouchers used for overseas mail. In reality, Ponzi purchased only a handful of coupons while taking in nearly $20 million, recycling new investors' money to pay off earlier clients. The Boston Post investigation, confirmed by a telegram from the city editor to the Atlanta Federal Penitentiary, exposed Ponzi's prior prison terms and triggered a postal probe. Within days, federal and state indictments followed. The absence of securities regulation in 1920 allowed the scheme to grow unchecked for 12 months. Ponzi's collapse established the basic mechanics for every investor fund recycling fraud that followed. Number 9. WorldCom's accounting fraud rewrote the rules of corporate deception. Between 1999 and 2002, the company reclassified $3.8 billion in routine line costs, which were expenses for leasing network capacity, as capital expenditures. This single shift allowed WorldCom to inflate its reported earnings by approximately $11 billion. Arthur Andersen, the audit firm, failed to flag the violation despite reviewing the company's Form 10-K filings and internal controls. The fraud unraveled in June 2002 when an internal audit team, led by Cynthia Cooper, delivered a memo to the board documenting the misclassification. WorldCom filed for bankruptcy in July 2002. Chief Executive Bernard Ebbers received a 25-year prison sentence in 2005. The case exposed how a basic accounting violation could persist for years when auditors and regulators overlooked clear red flags. Number 8. Crazy Eddie operated 2 consecutive frauds across nearly 2 decades. In the first phase, beginning in 1969, Eddie Antar and his family skimmed cash from retail sales to evade taxes, underreporting income, and concealing millions of dollars from the Internal Revenue Service. This continued until the company prepared for its 1984 initial public offering. At that point, the scheme reversed. The Antar family began inflating reported sales by channel stuffing, shipping excess inventory to distributors, and booking these as completed sales, even when goods were returned unsold. Quarterly revenues and inventory figures were overstated, creating a facade of rapid growth. Underwriters and the SEC relied on internal statements and failed to demand independent verification of cash reconciliations. The fraud unraveled in 1987 after a whistleblower exposed the manipulated financials. By the early 1990s, federal convictions followed, establishing Crazy Eddie as a forensic accounting case study in how inventory and revenue inflation can persist when oversight is weak. Number 7. Lou Pearlman built a financial empire on the illusion of airline leasing. Beginning in the 1980s, Pearlman sold shares in Transcontinental Airlines Travel Services, a company that claimed to own a fleet of aircraft. In reality, the planes did not exist. Over 25 years, he used glossy marketing materials and the credibility of his music management business to attract more than 1,700 investors. The scheme raised approximately $300 million before a series of investor complaints and state investigations exposed the fraud. Court records show that Pearlman's companies fabricated lease contracts and financial statements, while intermediaries performed only superficial due diligence. State securities regulators received early warnings but lacked the resources to coordinate a full investigation. Pearlman was convicted of fraud and money laundering in 2008 and died in federal custody in 2016. The case stands as a lesson in how asset fiction, when paired with celebrity veneer and weak oversight, can persist for decades. Number 6. Olympus concealed $1.7 billion in trading losses through a Tobashi scheme that spanned nearly 2 decades. The mechanism relied on off-balance sheet offshore entities and inflated advisory fees paid on acquisitions. These payments masked the true cost of failed investments, allowing Olympus to defer massive write-downs from the 1990s into the 2000s. In October 2011, CEO Michael Woodford raised questions about the advisory fee structure. 2 weeks later, the board dismissed him for insubordination. Japan's Financial Services Agency did not flag the offshore vehicles, citing disclosures filed under a foreign issuer regime with limited scrutiny. The case exposed how board-level retaliation and weak regulatory oversight can let a billion-dollar concealment persist inside a major listed firm. Number 5. Parmalat's collapse exposed the power of document forgery and a vast shell network to sustain a €14 billion hole for over a decade. In December 2003, Italian prosecutors discovered that Parmalat's finance department had fabricated a Bank of America confirmation letter claiming €3.95 billion rested in a Cayman Islands account. The letter, inserted directly into Deloitte's audit work papers, went unchallenged for years. More than 200 shell companies, spread across 4 jurisdictions, masked non-existent cash and recycled debt. When Bank of America publicly repudiated the confirmation, Parmalat filed for bankruptcy protection. Founder Callisto Tanzi was sentenced to 18 years in prison in 2010. The case remains a textbook example of how over-reliance on client-supplied documents and opaque offshore structures can defeat even the largest audit firms. Number 4. Stanford's offshore certificate of deposit scheme raised $7 billion between 1986 and 2009 by offering consistently high returns from a bank in Antigua. The certificates promise safety and performance backed by claims of the equivalent of FDIC protection. In reality, new deposits funded interest payments, a classic Ponzi structure, while the supposed investments existed only on paper. Stanford secured a knighthood from Antigua and Barbuda in 2006 and cultivated close ties with the island's financial regulator. In 2013, the chief Antiguan regulator pleaded guilty to accepting bribes from Stanford's representatives, confirming that oversight had been deliberately compromised. The U.S. Securities and Exchange Commission filed its civil complaint on February 17, 2009. Stanford was convicted in 2012. The case exposed how cross-border enforcement gaps and regulator capture can let a $7 billion fraud operate in plain sight for more than 2 decades. Coming to the top 3, Wirecard's collapse exposed the vulnerabilities of modern fintech oversight. For 15 years, Wirecard reported €1.9 billion as held in Philippine trust accounts, balances later confirmed by the Philippine Central Bank to never have existed. The fraud unraveled in June 2020, but not before Germany's financial regulator, BaFin, intervened to protect Wirecard's reputation. In early 2019, BaFin imposed a ban on short selling of Wirecard shares and filed a criminal complaint against Financial Times journalists Dan McCrum and Stefania Palma, who had published detailed investigations into the missing cash. Instead of launching a forensic audit, BaFin pursued the critics. Internal minutes show the regulator's risk unit was overruled by senior management under political pressure. The missing funds were only acknowledged after the Philippine Central Bank issued a public denial of any such accounts. Chief Operating Officer John Marsalek fled Germany and remains a fugitive. Wirecard's case demonstrates how regulatory intimidation of whistleblowers and journalists can allow large-scale accounting fraud to persist until the evidence is impossible to ignore. In second place, Enron transformed projected profits into present-day earnings using mark-to-market accounting. This mechanism allowed the company to record the estimated value of future contracts as immediate revenue, regardless of actual cash flow or contract performance. Between 1985 and 2001, Enron created a labyrinth of special-purpose vehicles, Jedi, Chuko, Raptor, and LJM, designed to move debt off the balance sheet and conceal mounting liabilities. The firm's 10K filings from 1999 to 2001 showed billions in reported assets and revenue that existed only on paper. Internal documents and Department of Justice trial records later revealed that these entities recycled Enron's own stock as collateral, inflating asset values and hiding losses. In August 2001, Vice President Sharon Watkins submitted a memo to Chief Executive Officer Kenneth Lay warning of imminent collapse. Her concerns were dismissed, and Enron's auditor, Arthur Anderson, continued to sign off on the accounts. Anderson's reliance on client fees and willingness to accept management's representations led to its conviction for obstruction of justice and dissolution in 2002. The Public Company Accounting Oversight Board cited a lack of professional skepticism as a root cause. When Enron filed for bankruptcy on December 2, 2001, more than $11 billion in hidden liabilities came to light. Jeffrey Skilling received a 24-year sentence, later reduced. The Enron case stands as the most complex accounting fraud of its era, exposing how auditor dependency and regulatory blind spots can sustain a multi-billion-dollar deception until collapse is unavoidable. And finally, in first place, Bernie Madoff's operation stands as the longest-running and largest financial fraud in modern history. For more than 3 decades, Madoff claimed to manage up to $65 billion in client assets, producing steady, above-market returns regardless of market conditions. The mechanism was a classic Ponzi structure. New investor funds paid withdrawals and fabricated profits. Yet the scale and longevity of the deception were made possible by a complete institutional breakdown. Madoff's auditor, Freeling and Horowitz, was a 3-person firm based in a suburban strip mall, signing off on statements for tens of billions of dollars in supposed assets. The Public Company Accounting Oversight Board never flagged the mismatch between the audit firm's size and Madoff's reported holdings. Between 2000 and 2008, independent analyst Harry Markopolos submitted 5 formal, mathematically detailed warnings to the Securities and Exchange Commission. Each submission outlined the statistical impossibility of Madoff's reported returns, the absence of any independent custodian, and the lack of market impact from supposed trades. The SEC routed these complaints through multiple offices, lost paperwork, and repeatedly closed cases without enforcement. It was only in December 2008, under pressure from redemption requests during the financial crisis, that Madoff confessed to his sons and surrendered to authorities. The court sentenced him to 150 years in federal prison in 2009. He died in custody in 2021. The Madoff case closes the cycle begun by Charles Ponzi, but on a scale never seen before. Every institutional safeguard, including auditors, regulators, and whistleblower channels, failed, not through lack of warning, but through a systemic unwillingness to act. The blind spots that allowed this $65 billion illusion to persist are not relics of the past. They remain embedded in the architecture of modern finance. Across all 10 frauds, one fact stands: the decisive factor was not criminal innovation, but institutional inaction. Regulators, auditors, and gatekeepers repeatedly failed to intervene despite credible warnings and clear forensic evidence. These vulnerabilities remain embedded within global financial oversight. Structural failure, not individual misconduct, is the recurring risk.